Hello, everybody, and welcome to the next video for the Butte County Library's REACH program. And this time we're going to be talking about New Year's resolutions, specifically financial New Year's resolutions, and some of the more common ones that people tend to make, and why people maybe don't stick to their resolutions, but maybe some ways that you can, and some ideas for if you have a New Year's resolution, specifically in the financial areas. We'll talk about some of the most common ones and some ideas to help you kind of move forward and keep going throughout the year and not just give up after the end of January like a lot of people do. So first things first, I want to talk a little bit about the program, the Butte County REACH program, just to make sure we all know what it is. But every week we post some videos, either live or pre-recorded, about financial topics. In addition, the Butte County REACH program covers things for job seekers and for business owners and all kinds of different topics. But this video is part of the financial series. And so every Friday, at least for the beginning of 2022, we'll be covering a different financial topic. And so this one is on New Year's resolutions, financial New Year's resolutions. But in the future, we're going to cover things like talking to your kids about money, some tax considerations for both individuals and for businesses, how to build credit, some retirement planning, how much do you need to save for retirement, and many other topics, all kinds of things related to personal finance and things that people in Butte County might need to know about. And so we just want to be able to provide that service to you to make sure that you have everything you need to be successful. You can visit the buttecounty.net, which is the county's website, and then /BC for Butte County Library. And you can find the REACH program on their website, or you could just go to your favorite internet search engine and search Butte County Library, and I'm sure it'll be one of the first links available there. So without any further ado, let's get into some of the more common resolutions. So in some surveys that have been done by a few different organizations, some of the more common financial resolutions would be things like paying off debt or growing an emergency fund. These are probably the top, I didn't count them, but 7 or 8 most common, looks like 8 most common financial resolutions that people make. So paying off debt, growing emergency funds, creating an estate plan or updating beneficiaries or things similar to those, improving your credit, paying off student loans specifically. One is general paying off high interest debt, but paying off student loans is another one that people specifically have a New Year's resolution for. Giving more to charity, increasing your income, or investing more in a retirement account. So all of those are great resolutions to have and great goals to set up. And each of them kind of comes with its own challenges and things to think about, and difficulties that can kind of crop up without maybe expecting it. So we'll kind of go through some of these and talk about some ways that we might be able to be successful in these areas, and then some things we might want to think about when we develop a plan and try to move forward throughout the rest of the year beyond just January. So start with paying off debt, and student loans is one big one that's on there. And so because I work for a university, I'm very familiar with student loans and students who are worried about paying off their student loans. So there's a website, Student Loan Hero, and they're a company that does student loan refinancing and provides a lot of data surrounding student loans. And so they put together a survey and surveyed some and got some data from the Department of Education that showed that the class of 2019, 70% of graduates for the class of 2019 had student loans, which is huge. That's so many. So just such a large percentage of students who have student loans. And they had an average balance of about $30,000. I'd say that's not unrealistic or out of context for people who graduate from Chico State. I've seen many students who have about that amount in student loans when they graduate from Chico State as well. So I'd say that if that's the national average, which that is, that 30,000 is national average, it's true at the unique case of Chico as well. In total, nationwide, there's $1.7 trillion in student loan debt. So it's a pretty big deal in our country. And then because of the pandemic, the Department of Education actually put a pause on repayment and stopped building interest on against student borrowers or anybody who has borrowed for student loans. And so that kind of changed the way that statistics are measured. But prior to that, about 11% of borrowers were in default, which means that they had missed payments. And actually, I think that percentage actually was of borrowers who are more than 90 days in default, who had missed a payment by 90 days. So it's quite a struggle. Now, what can you do to address student loan repayment if that's one of your goals? First thing I do is, it depends on when you borrowed your student loans, your interest rate may be different than other people's. The Congress sets interest rates on student loans every year, and so they may change. Well, they have most years they have changed what the student loan interest rate is, and so yours may be different than someone else's. And so depending on how high your student loan interest rate is will dictate how much of a priority paying off your student loans is. If you have a very low interest rate on your student loans, especially if it's federal student loans are the ones that Congress sets interest rates on. And if you have a very low interest rate, federal student loans tend to be much lower interest rates than private student loans. It may not be a priority for you to pay them off very quickly, because you may have other forms of debt that have higher rates. And so something like a credit card, which generally will have a much higher interest rate than a student loan, that might be more of a priority for you. But if you have federal student loans, meaning that you borrowed through the Department of Education, generally you would have filled out a form called the FAFSA in order to get federal student loans. And so if you are in that situation, then there are some repayment plans available for federal student loan borrowers. And so something you can do is go to your student loan servicer. If you're not sure who your student loan servicer is, you can go to studentaid.gov and find out. You have to create a profile and log in, but if you log in using your social security number, it's the Department of Education, and they will tell you who services your student loans and who to contact in order to get information about your student loans. And so if you're going to look at repaying your student loans, you may be served better by setting up your student loans on a certain kind of repayment plan. And depending on your situation, there's going to be a lot of different options, but that same website, the Student Loan Data Center, that used to be called NSLDS, which was the National Student Loan Data Center or Data Service. And now it's just studentaid.gov. But on there, they will tell you, you can put in some of your information and your income, and they can tell you what your monthly payment would look like and how long you would be paying for under different repayment plans. And that's one of the great benefits to a federal student loan, is that they have so many options available. So one that is available is you can extend it out 25 years. Now, that is nice if you are on a tight budget and you want to try to lower your monthly payment. A 25-year extended repayment plan would absolutely lower how much you have to pay every month. The downside to that is you're going to pay your loan off over 25 years, which is significantly longer than what normally someone would pay on their student loan. And so over time, you're going to end up paying a lot more towards interest, rather than if you were able to pay a higher amount and pay it over maybe 10 years instead of 25. There's also an income-based repayment option, and there's actually a number of income-based type repayments, but they set it up so that if your income is below 150% of the poverty line, you actually don't have any payment whatsoever. If you make more than that, and the poverty line is determined by the state and by the size of your household, I believe. And so if you make more than 150% of the poverty line, in income, then they will set up your repayments to be kind of pro rata. So you may end up paying a little bit. If you are lower income, you may end up paying a lot. And then this is one place where it's a really good idea to compare the different plans, because if you go on income-based repayment, but you make a decent income, you make quite a bit of money, you could end up actually paying more each month than if you were on a lower, like a standard repayment, which would be a 10-year repayment. And so you want to compare the different repayment plans and only choose the one that works best for you. If you want to pay more every month, you absolutely can on federal loans. No one stops you from paying more. There is no prepayment penalty for federal student loans. So rather than set up an income-based repayment for somebody with a high income, you can just make the payment without actually tying yourself to an income-based repayment plan. There's also one called a graduated repayment, and there's others too, but these are the ones that I thought would be most useful to touch on. Graduated repayment means they start off really low, and every couple of years, every 2 years, they will increase your payment just a little bit. And the idea for that is that if you maybe graduated from college and got your first job and are going to continue working and working your way up the corporate ladder over many years, you probably will increase your income little by little over years. And so they start off with lower repayments, and then as your income increases, your student loan repayment amount will also increase. And so over time, you'll pay a little bit more every month, but you'll end up paying it off. You could end up paying it off over 10 years. You could extend, they do graduated extended repayment as well, so you could extend that over a longer period of time. But generally, it's a little easier to start off with a lower repayment amount, and then, as you kind of get more comfortable in a career path and more experience in your industry, you probably make more money and then are able to handle a higher repayment plan later down the line. Now, those are federal repayment plans. For student loans that are privately funded, so maybe you went to a bank or you went to a private lender. There's some pretty popular, well-known ones, but you can think of, generally private banks would lend for student loans. And if you got one through there, you really don't have a lot of repayment options. Most banks don't, have the same kind of weight to throw around that the federal government does. And so they just say, listen, every time we hand out a student loan, it's got a 10-year repayment and that's it. And so it's not as convenient to have a private loan. And so one thing I recommend to most students that I work with is that if you have federal student loans and you're considering refinancing them, do not refinance federal student loans into a private student loan. Don't create a private loan where you currently have federal ones, because the private loan is so much more rigid and so much less flexible to in terms of repayment. It's much better to stay with federal student loans. And in fact, there's never really a good reason to refinance federal student loans, because one of the main arguments they make is that, well, you can refinance it into one loan and then just make one payment on that one loan. And that is a little bit of a convincing argument, except that if all of your federal student loans are, if all of your loans, your student loans are federal student loans, then you can actually pay them all with a single payment anyway. And so it doesn't really matter that you have multiple different student loans. They're all going to be served by the same servicer. That could be like a Navient or a Fed Loan Servicing, or, well, actually both of those companies are going to be leaving the federal student loan program soon, but maybe something like Great Lakes or Nelnet or something like that. Those are all companies that service federal student loans, and you would be making one payment anyway. So it's never really that beneficial to refinance federal student loans. And so I always recommend go to studentaid.gov, see what repayment plans are available to you, see what the payment would be and how long they would be for, and then compare and contrast the different options. So the next goal that came up with New Year's resolutions was to grow savings amounts, so grow the amount in your savings. And so I kind of interpret this to mean, emergency savings, and how much do you have set aside in case of an emergency. And so in order to grow your savings amount, you kind of need to know how much do you need, right? Maybe you already have enough. Maybe your goal was to grow your savings, but it turns out you actually have plenty and you're okay. Sometimes people think that they need to have a certain amount, and when they actually sit down and do the math, it turns out they didn't need as much as they thought, which is awesome. Some people definitely do need quite a bit of savings, especially for people who maybe work in a more risky career field or industry, where it's possible to lose. It's more likely that you may lose your job, or you may be injured at work if you're in a more high risk type employment. And so having savings set aside is going to be very useful. There was a survey done and a study done, and it was published by CNBC, and I have a link here. But CNBC's article said that 51% of Americans don't have 3 months of emergency savings. And this is as of the summer of 2021. And so it ended up being, kind of really detrimental to American savings that we were in this pandemic, and a lot of people ended up leaving their work, or they were out of work because either their business where they worked had to shut down, or there just was less profits, or even supply chain issues, or all kinds of things where people are losing their incomes and they don't have very much in savings. And so having a emergency fund available is really important now more than it ever has been, really. And so how to decide how much you need in emergency savings? Well, the first thing I do is when I work with clients, I'd say, let's look at what your spending patterns are. Because if you create a spending plan or a budget, or you just look at what historically you've spent money on, you maybe, a lot of people kind of shy away from the idea of creating a budget because it's not exciting and it feels like you're kind of putting a cap on your ability to do anything fun. And I understand that psychologically. I understand not wanting to create a budget. But what you can do in order to try to grow your savings is say, well, how much do I spend on average monthly? And do I have enough money to cover some of those months? How many months do you need to cover is the question. 3 to 6 is the general, 3 to 6 months is the general advice. But if you, again, I'm going to say, if you work in a more risky environment, let's say you work in construction where there's like booming times and then not so exciting times, right? And winters and the rainy seasons and those kinds of things tend to be a lot less construction work happens. And so you may know that pretty common, you're going to have 3 months of hardly any income. But then when it comes to be summer, you might be working a lot, right? And things might be going really well. The same is true for people in like really heavy machinery type industries, or like oil drilling and those kinds of things, mining and those kinds of things, where there's ebbs and flows and some seasonality to those industries. And I don't really know those industries very well, but that's just kind of the assumption I have, and kind of what I've seen from people who I know who work in those industries. And so if you work in a field where you are more likely to be either unemployed or lower income for a set amount of time, then you're going to want to have more of an emergency fund. You might want to cover 6 months worth of emergency savings, so that when those times happen where you have much lower income or maybe no income, sure, you can apply for unemployment and that might be helpful as well. But having that savings built up, 6 months of emergency savings, is going to be really great to help get you through that rougher patch. Now, if you're in a kind of job where it's not so seasonal, maybe you're in like a union kind of situation, or maybe you're in a situation where you're in a very high demand field. And so even if you did lose your job for some reason, you could get another one very quickly. Well, then, okay, you might not be worried so much about being unemployed and being short on cash. Or having to kind of bridge a gap so much. You say, listen, I could go get a job in like 7 other companies, tomorrow if I wanted to. Well, then that's awesome. That's really great that you're able to do that. And you might not need 6 months worth of emergency savings, because it's very unlikely that you're going to go 6 months unemployed, right? And so you say, well, 3 months is a good amount, just in case maybe you change your mind about your career and you want to go in a different field or something like that. Or maybe something just completely unexpected happens where you're injured, or some kind of medical scenario happens where you end up being unable to work for some amount of time. Well, then 3 months might be okay, because the likelihood of you having to bridge a very long gap is low, but you still want to have some amount of savings for completely unexpected things that may come up. So great ways to help build a savings account. The first thing that I say is to automate as much as you can. And so the way that you can do that is set up direct deposit. If you work for an organization that allows you to have direct deposit, that's perfect, because you don't have to, go pick up your check, deposit it, wait 2 days for the check to clear, right? You can just get direct deposited straight into your account. And then you might know, at least with me, I have direct deposit set up for my income, for my employer. And then what I do is I know that I'm going to get paid on the same day every month. And so I know when that money is going to come in. And so I have all of my bills automatically paid. The things that I regularly have, my mortgage, I have insurance payments, I have automated savings to my retirement accounts. All of those things happen immediately upon my direct deposit from my employer. And so when the money comes in, it automatically goes to places it needs to go. And the only money that's left in my main checking account is money that I know that I can spend on things that are more of my wants, because all of my needs were immediately covered without me ever even having to touch them. And that's a great system to set up if you're able to do it. Not everyone's able to do it, but if you are able to do it, that's awesome. The pay yourself first doctrine that's on there as well is the idea that when you get paid, put it into savings right away and spend what you have left. Don't spend throughout the month and try to save what you have left at the end of the month. Save whatever you need to save early on and then spend from what you have left from there, right? And so pay yourself first means pay into your own savings, pay into your future, pay into your retirement savings, whatever it is that's important to you, but put money towards yourself and your needs first, and then let the leftovers be what you spend from. Those are really important tips. Another one that I always tell my students who have, maybe struggle a little bit with having their checking and their savings account, and they're like, well, I've been trying to save, but then I see this great deal on Amazon, and so I transfer money back from my savings into my checking so I can buy this thing. That comes up all the time. I totally get that. And if you're the kind of person who struggles a little bit with, I do put money into savings, but then I pull it back out because this thing happens. I generally tell my students and clients at the Financial Wellness Clinic at Chico State, I say, if you have that struggle, have your savings account at a separate bank or a separate institution from where your main checking is. So it's so much harder to transfer out of savings, right? If both of your accounts are at, say, Wells Fargo, for example, it's really easy to just transfer between your checking and savings account at Wells Fargo, right? But if you have one account at Wells Fargo and another one at Golden One, well, then it's really difficult to transfer, right? You'd have to either write yourself a check or you'd have to go spend. You can't really spend out of a savings account. They don't have a debit card as easily from a savings account as they do from a checking account. And so if you have them at separate institutions, it's not like you can't get your money if you did have an emergency, but it makes it much harder to just willy-nilly spend on some, some sale that popped up or some ad that you saw. It's much harder to spend that way. So those are kind of my three biggest recommendations for how to get your savings going, is to automate it, to pay yourself first, and to try to separate your savings from your checking so that you don't transfer back and forth so easily. So another question, or another common New Year's resolution, is to set up some estate planning. And one of the most common things that came up with that is designating beneficiaries for your accounts. So if you have a retirement account, when you create a retirement account, usually you might do that through like an online stockbroker. So Fidelity is a very common one, a very popular one. So is Vanguard. And you may go and create like an IRA, or your work may have set up a 401k for you or something like that. Those are all different kinds of retirement accounts. And when you create those, you generally have to designate what's called a beneficiary. And a beneficiary is somebody who will receive those funds in your account if you were to die. And so estate planning, the concept of estate planning, and we'll do a video specific on estate planning later, but the concept of estate planning is essentially what to do with your property after you pass away. And so most people should have a will in place so that they can say what they want to happen to their property after they die. And then another thing that comes up quite a bit, although it's not for everybody, but it can be very useful for the right person, is having a trust. And a trust can separate your property from the court system after you pass away. And so that in estate planning, the court system we call probate. And so when you die, if there's any question or any issue about where your property should go, who it should go to, you don't really want that to get tied up in the court system. And that's, it'd be really unfortunate if maybe you wanted to leave all of your things to one of your children, and then someone else comes to argue that you should have left it to them, and then there's a whole legal battle. You don't want to deal with any of that. So generally a will, when you have a will, a last will and testament, they call it, that will go through the probate court system. But if there's no argument about it, it could be a little bit faster. There may be some costs associated with that. If you have a trust, you can have all of your property go into a trust, which generally, this may be confusing to some people, but I kind of think of a trust as like a separate person entirely who just deals with things, right? And so if you say, I'm going to put all of my property into a trust, the trust will then be the thing that gives your property out to whoever you want it to go to. It can go to your children. It can go to your still surviving spouse if you have one. It can go to a charity. It can go to any, I've heard of people like leaving all of their things to their dog. I don't know if legally, if that's something that really can be done, but I've heard of it on the news. And so, a trust might be a good option as well. And one of the things you might have heard of, like a trust fund kid, that's a common, like maybe derogatory thing to call someone, but you can set up a trust so that the funds will sit there until maybe you have a minor child, and maybe that the funds will wait until you can put any rule you want, but it could be something like once they hit age 30, then they can have access to these funds, or once they reach age 25, or what is pretty common is once they reach age 18, they're an adult, and then they can have the funds then too. But you can set up rules around that as well. And so that's a really good option. So beneficiary, a primary beneficiary, is the person to receive the property or the money or whatever it is that you're either willing or leaving in trust to someone. And the primary beneficiary will be the person who receives it if you designate them. And then what's a really good idea for estate planning purposes is to also name what's called a contingent beneficiary. And a contingent beneficiary is the person who would receive those funds if the primary beneficiary is not able to for some reason. It could be that they also passed away, or it could be that they are just unable because they don't want to. That happens. It's not as common for somebody to decline receiving an inheritance, but they can. And so it can go to a contingent beneficiary. Or it could be for any number of other reasons that someone maybe can't receive a certain type of property or something like that. So a contingent beneficiary is a great option as well. And so the last thing on here is how might you designate to leave your property to your heirs. If you have a retirement account, they might ask you, do you want this beneficiary to be named either per capita or per stirpes? Per stirpes and per capita are two different ways to leave assets and property to people. And so let's say I'm going to use my drawing pen right here and say, so if you want to leave property to your children, you can do that through either a will or through a trust, and you have no problem, setting those up and naming the people who you want to leave property to, either through a will or a trust. And you can do that, and then you may go 50-50, 50 to one child and 50 to the other child, and be good to go. But what happens if child number 2 right here happens to pass away at the same time? Maybe maybe something, some accident happens and both of you pass away together, and your original plan was that you wanted 50-50 to each child, but now this child number 2 here has passed away, and so they can't receive it, right? And so if you're in the per capita system, then what would end up happening is 100% would go to child 1. And if you don't make any, that's the default system. So if you don't make any declaration about primary contingent beneficiaries or per capita and per stirpes, then the default system is whoever remaining children there are will divide up. And in this case, there's only one child left, and so they get everything. And that might work for a lot of people. You might say, okay, yeah, well, that's kind of what I wanted. It goes to my one child. And that's fine. If that's what you want, that's fine. I just want you to know what the options are. And so per capita is where it goes split amongst whoever is living at that same line. So you can see right here, that same line, there's children in this line and then grandchildren below that. And so in the per capita system, the grandchildren wouldn't get anything. Now, if you set it up for per stirpes says, you can kind of think, I always see stirpes and think the word stripes, right? And so stripes kind of go like this, right? There's up and downs. And so they're each in their own kind of column here. And so in per stirpes, it would go 50%, let's go 50% to this line and then 50% to this line. And if you and child number 2 pass away at the same time, or child number 2 predeceases you, meaning they passed away first, either way, if they're not available to receive their 50%, then that 50% will get split amongst their heirs themselves. And so each grandchild would get a 25 and a 25 in this scenario, and then the child number 1, your original child there, would receive 50%. And so those are just 2 options, and depending on what you want and kind of maybe probably the laws in your area, but there's a few different ways that you could set that up. And so if your goal is to, if your New Year's resolution is to set up an estate plan, I would say starting with a will is a great place to start. And there are estate planning attorneys who that's what they focus on. And that's what they do, is they help you create a will or a trust. And they can tell you do you need a trust? Is your life complex enough to where a trust would serve you, or can you get by with a will? And if you don't have lots of property and lots of money, then maybe a will is just fine, and that's all you need. But depending on how you want to set up your plan for after you pass away, some people may be in need of a trust. And so I always recommend talking to an estate planning attorney to figure that out. There are a lot of services available online that can, kind of, set it up for you. But if you talk to somebody who's an actual attorney in the estate planning field, then they'll probably have some other things, some other ideas to share with you that maybe a software wouldn't think of. So that's just something to be aware of as well. So another New Year's resolution is improving credit scores. A lot of people want to build up their credit so that they can buy a home or get a better car loan or a better interest rate on a type of loan that they have. Or maybe they just want to make sure they have a good credit score just in case, because they may need it for something in the future. Renting apartments, typically you need to have a credit score. Otherwise, you may end up needing a co-signer. There's all kinds of reasons that people want to have a good credit score. And so generally, if you have a credit score of 740 or above, then you will be eligible to get the best interest rates. And so there's a lot of services. I don't want to plug anyone because I don't have any affiliation with anyone, but if I could name like 3 so I can be fair, Credit Karma, Credit Sesame, and Credit.com are 3 different kind of competing websites. And there's plenty of others as well, who you can go on those websites, put in a bunch of your private information. So be careful with sharing private information on the internet, but you can put in some of your information there, and they can give you an estimate as to what your credit score is. Any of those websites that aren't specifically FICO, they're really just estimating what your credit score is. The Fair Isaacs Corporation, which is FICO, they're the ones who kind of created and designed the idea of a credit score. They're the keepers of the formula that determines your credit score. And so you can pay money to any of the 3 big credit bureaus, which would be Equifax, Experian, or TransUnion. And any of those 3 credit bureaus would be able to tell you what your credit score is as well. And they have paid services. But if you wanted to improve your credit score, there's a few factors, actually 5 big factors that affect your credit score. But the biggest one by far is whether or not you've ever missed a payment. And so they call it payment history. And so if your payment history is that you're always on time, you always make more than the minimum, or at least the minimum, you're not penalized for making a minimum payment as long as you make at least the minimum. But if you're always on time and you always make at least the minimum payment, your payments factor is going to be just fine. You don't have to worry about it. But if you've missed payments, and if you've missed a lot of payments, or you've missed them by a long time, they categorize missed payments by, is it 30 days late? Is it 60 days late? Is it 90 days late? And each of those is going to be significantly worse, as you can imagine, for your credit score. And so if you are very late and frequently late on payments, whether that's for a credit card, for a car loan, for a mortgage, any of those things, you're going to end up having a much lower credit score. And once those things are on your credit score, it's very difficult to get rid of them. There are some kind of ways that you might be able to get rid of them, but they're not particularly above board. You're not supposed to try to argue to get something that is legitimately, it's a true statement, removed from your credit score. If it's false, if there's something false that's on your credit score, there is 100% a process that you can go through to try to get false things removed from your credit score. We will have a video dedicated entirely to credit scores later. And so we'll go into some details about things like pay to delete and that kind of stuff. But for right now, this is just kind of some ideas to help with New Year's resolutions. So if your New Year's resolution is to improve your credit score, make sure first off, never miss payments if you can, and make at least the minimum payment. And if you've already missed payments and it's too late, then just from this point forward, continue making your payments on time, continue to make at least the minimum payment, and it will still build your credit score. And then the older that these missed payments are, the further in the past that they are, as time moves forward, these will become further and further in the past. They have less of a weighting on your credit score. They affect your credit score less. And so a missed payment will, over time, as long as you don't miss any more payments, it will be less and less of a negative factor on your score. The next most important thing after missed payment is utilization. So if you have a $10,000, for example, a $10,000 credit limit, and you're using $9,900 of that 10,000, that's a really high utilization. That means you're almost maxed out on your debt, and that's generally seen by a credit agency, like a credit score company. That's seen as kind of a negative factor. It means like you're really overextended and you can barely make it because you're not paying down your debt. You're at a really high debt level, and so they figure you might not be likely to make all your payments coming up if you're overextended on your debt. And so if you can keep a really low utilization, and generally the guidance is below 30%, they say to keep about close to 30% to have the best credit score. But in my experience, I've worked with a lot of clients on credit counseling, and you can have above a 740 credit score, which is the prime rate. If you're above 740 all the way up to 850, it's all the same. It doesn't matter. You may want to have the highest credit score, but having a 750 credit score and an 850 credit score isn't going to make any difference in terms of the rates that you're going to get on loans. And so having a 30% credit utilization, meaning you're utilizing 30% of your available credit. So again, I'll use the same number. If you have a $10,000 credit limit and you're using $3,000 of that, that's a 30% utilization, because 3,000 out of 10,000 is 30%. And so if you're utilizing 30%, that's that or less is going to be the best situation in terms of utilization. But if you have no credit card debt at all, you have a credit card, but it's completely paid off and you owe nothing on it, that's still going to be able to get you higher than a 740 credit score. I know that personally with my own credit score, because I have checked and I've paid off my credit card and I still have above a 740 credit score. And I know that with clients that I've worked with in the credit counseling space as well. So don't worry about trying to keep a little balance to show the credit card company that you're profitable as a client or anything like that. Don't worry about it. The only negative factor that I've ever seen with having a completely paid off credit card is if you have it paid off and you don't use it for a very long time, maybe a few years, the credit card company might cancel the card because they think, well, this person's not using it. Why do we even bother having it open? And they might cancel it. So sometimes you might just want to use it every once in a while, just for something that you're going to pay cash anyway. And so you just use it real quick, pay it off, and it's good to go. The next most important piece of your credit score is your average credit age. And that's something that we can't really do anything about. You just have to get older. And that's the hardest advice I ever have to give, especially to my students who are maybe sometimes are 18 years old. I say, listen, the only way to improve this is to get older. And then that's all I got for you. And it's unfortunate that that's one of the factors here is age. But once an account has been open for a longer period of time, the way that the credit agencies see that is that you have more experience handling debt, which means you are probably less risky in terms of overextending your debt and forgetting to make payments or not being able to make payments because it's just too much debt, right? They figure the more experience you have, not just with borrowing, but with life in general, you're going to be more mature. You're going to be a better risk from their perspective. They'd be more likely to lend to you. And so it's just going to increase your credit score just because it's older. Once you hit 7 years, if you have an account that's been open for 7 years or longer, then it's not going to get any better than that. That's the best that you can get in terms of age. And then if you don't need to borrow any money, you can freeze your credit. And so what happens if you put in a credit freeze is that no one can steal your identity to borrow using your name. And so it also means that you can't borrow using your own name because it is you. A frozen credit means that no one can borrow under that name, which is, if you don't need to borrow any money, if you know, I don't need a new car loan or a new mortgage or a new credit card or any of those things, then you can freeze your credit and say, you know what, I don't need to borrow, and definitely no one else needs to borrow using my name, and so I'm going to freeze it. And so that kind of helps with identity theft. I've had my identity stolen in the past. And so what I did is, once I found out, I immediately froze my credit, and I've never unfrozen it since. And so no one has been able to steal my identity since then, which is nice to know that now that that's fixed, I can leave that freeze on there so that I don't have to worry about identity theft. The next New Year's resolution is increasing income. And that's really, that's where the biggest challenge in terms of financial counseling that I do with clients is, it's a hard one. We can all sit down and say, well, I need to cut expenses. I need to stop spending here. And that's something that most people kind of know how to do, but increasing income is much harder for a lot of people. So you may want to do like we call it a side hustle or a side gig. You may, it could just be that you have like an entrepreneurial dream. And so I love to plug Chico Start. They're a partner of ours at Chico State and in town as well. And so Chico Start is a business incubator downtown, and they might be able to help you out as well. If you're interested in starting your own business or getting involved in the entrepreneurship hustle, they're a great resource. They have mentors, they have workshops. They're part of the Butte County Reach program. This video right now, part of Butte County Reach. Chico Start as well has a series called Grow with Google, and they have mentors that help with people who want to start businesses or start some kind of passive income, side income kind of thing. So I highly recommend reaching out to them. They're downtown in Chico, across from the downtown plaza. They're in the newer side, I think, of the city hall building that's over there. Or another thing you could do if you want to increase your income, besides starting a business or starting some type of side income, is you may take like a lateral move so that you have a more upward trajectory or more upward potential in your career. Maybe where you are right now, you know that there's not really an upward potential. There's no way for you to get a promotion because maybe your boss is not likely to retire or leave soon, and so you're stuck where you are. Well, maybe you take a lateral move to another organization or another department or something like that, where there is upward potential. And then so it's kind of, you have to play the long game a little bit. You say, well, okay, yeah, there's might be nothing I can do to increase my income like right now, this month. But over the next few years, if I were to take, leave my current job to go over here, I don't get paid anymore. I get paid the same amount, but over the next couple of years, I could get more. I did that with a job move that I did a number of years ago, where I took a new job and ended up making maybe like $100 more total. Like it was not an increase in pay, but the new job after I changed allowed me to increase my potential income. And actually I did increase my income pretty significantly after that, because it allowed me to do so many more things outside of my work. I wasn't working 15-hour days anymore. I switched to a job where it was a lot less taken out of me so that I could do other things that ended up increasing my income as well. And so it took a while for that to build up and for that to happen, but eventually I got there. And so it really worked out for me. Another thing you can do is go back to school or go get a certification. I'm working on a few different certification projects for myself because I always want to learn more and learn new things. And so one thing you can do is either go back to school. They have a lot of now that we've gone through the pandemic. There's a lot more options for online education. You don't necessarily have to be physically located somewhere. Although I will say, because I work for Chico State and I think the program is great, Chico State, and if you're in Butte County, Chico State is local. Butte College is also available, and you can go take classes and learn new things, and that might help you to be able to get higher pay. My mom is a first grade teacher, and she went back to school and got a master's degree so that she could end up making more money. And this was a number of years ago, but she ended up doing that about the same time that I started grad school as well. And so my mom and I were both in completely different programs, but we were both in master's degrees programs at the same time, and that was really fun. And so she was able to make more money, and then I was able to move on with my career as well. So if that's a path, you kind of have to think of the long game and say, well, yeah, more education is probably going to be more expensive because you have to pay for a degree, whether that's, for me, I'm talking about a master's degree, but if you want to get an associate's degree, or you want to just get certified in a particular field or licensed to do a different kind of business or any of those kinds of things, it could definitely increase your income, but it might cost a little bit up front. So you have to kind of do that cost benefit analysis and say, well, if I'm going to spend so many dollars to get this certification or education, how many years of work ahead of me do I have? If I can increase my income a little bit, but I can only do it for 1 or 2 years before I can't do that anymore, well, it might not be worth it. But if you're early on in your career, you say, listen, I'm going to spend a bunch of money, but I'm 30 and I have another 30 years ahead of me of being able to do this work where I'm going to get paid more money. Well, then it probably was worth it to spend more on that education in order to make more money and work there for 30 years, right? So you just kind of have to weigh that pros and cons situation, and it's going to be unique to everybody. So I can't give everyone just a blanket answer, but you know for yourself whether or not something is worth it. Last one I think on in terms of retirement, in terms of New Year's resolutions would be investing for retirement. And so one of the things that people want to do is be able to save money for retirement. And we're gonna have another video. This topic that we'll have a video in depth on is how much do you need. But if you already maybe work for a company that provides a 401k, opening an IRA is a great option to supplement that if you think maybe you need to save more. If you are already contributing and maxing out a 401k, you still need to save more to meet your goals, then an IRA might be a good way to do that. Or you may be able to open other kinds of accounts depending on your situation. And we'll have a video that dives deep into the types of retirement accounts available and how much you can make in order to contribute to different amounts, what the limits are, those kinds of things. But my main recommendation is that if you can start young, putting money into savings, into a retirement account, and let it build over time, the longer you can be in the market in investing and getting a return, the better off you're going to be. And so there's a phrase that we say in the finance world: time in the market beats timing the market. And what that means is the longer you can be invested over and save for a much longer period of time, the younger you start, the better off you're going to be compared to trying to get the home run of the stock market, right? Trying to get the biggest returns and trying to buy GameStop before it goes up and Bitcoin before it's goes up and whatever other things happen, right? If you can just be in the market for the long haul, you're going to be just fine. Just buy and hold and keep adding more money and keep buying and holding, and don't worry about the daily ups and downs. For the most part, unless you're going to be focusing on it as a job, like people who are investment managers, that's their job, is to keep track of the ups and downs. But if that's not your job, don't stress about it. Don't worry. Just put money in, buy generally broad, diversified investments, let it sit, let it ride for many years, start early, save as much as you can. You're going to be just fine. So those are my recommendations for retirement, but we will definitely dive deep into different types of retirement accounts and how those would work for you in the future. So the next step here, so those are all the main New Year's resolutions that a lot of people have. And so I also want to talk about sticking to your goals. So if you've decided what your New Year's resolution is and you know exactly what you want to focus on, it may not even be financial. A lot of people have, health related New Year's resolutions, especially coming out of COVID here. We're thinking about trying to exercise more, trying to maybe, if you were, locked down for a while, you might've put on some weight. I know I did. And so, you might want to, be going to the gym, and that's a pretty common New Year's resolution, is to go to the gym, right? And we all know January, the gym's packed. February is a lot lighter. March, it's back to normal, right? And so that's kind of what the idea of this presentation was, is to say, listen, your New Year's resolution is you're going to have no problem, handling it in January. It's the February, March, April that we need to worry about, right? We need to stick to it. And so that's why this video is coming out at the end of January, about the time where people start to fall off, right? And so the one thing or a few things that I might recommend would be, focus on either one goal or try to break it into smaller steps, or try to make it bite-sized and manageable. Because if you have one huge goal, if your goal is, I want to be able to run a marathon, and you've never been very active, that's a big ask, right? But if your goal is small, to say, I want to be more active, just that's it, I want to be more active, then you can break it into small pieces. Say maybe I go for a walk in the afternoons, or after work I go for a walk around the block, and just have that's just be your starting piece. You say, I'm going to go for a walk around the block every day after work, and then I'm going to come home and I'll go back to my regular day, making dinner and doing whatever else. And that could be a good start. And then over time you end up adding to it. And so instead of going for a walk around the block, maybe you go for a run around the block, and then maybe on weekend you go for a jog, and then maybe you increase the distance that you're running or something, and eventually you build it up to the ability to do a whole marathon, right? And so that might be, you just do little by little by little, and let yourself kind of, we call it gamify, where you put it into little goals and say, I need to hit this target, and then I can hit this target. And then just like you would in a video game where you kind of build your way up, and it gets harder and harder and harder as you play. but you start off kind of easy, level 1, and then you get to level 2. It's that same kind of thing. And just do that with your goals, so that level 1, go for a walk. Level 10, running a marathon, and then figure out where all the levels are between those. Another thing that might help to just motivate you is to have a vision board. And so I used to work for an organization where we made clipboards. This is a clipboard version of a vision board. And so me and a bunch of, there was like 10 of us that were all coworkers, and we all drew names out of a hat, and we made these clipboards for each other. And so somebody made this for me, and it's got, you know, financy market type stuff all over it. And so they knew that my interests were, you know, finance and savings and building wealth. And so they cut out a bunch of things from magazines and made a collage. And that's what these are. And you can see on both sides, there's all kinds of, you know, financy, motivational type stuff on here. You know, money and plants growing and piggy banks, all that kind of stuff. And it was, you know, it's really meaningful, you know, that one, I love that somebody made it for me, but two, every time I look at it, because it's a clipboard, I use it all the time. You know, I'm always, you know, anytime I'm taking notes, I put them on my clipboard and I can see it pretty frequently. And so I can, you know, always remember like, oh, these are the things that I want to do. I want to, you know, be more involved in the stock market. I want to be more involved in financial planning. I want to be able to meet with clients more frequently, those kinds of things. And so it's just, you know, things that are interesting to me and things that are helpful to kind of motivate me to keep going. And a vision board doesn't have to always say like, this is your main goal and you need to look at it every day. Sometimes it can just be things that motivate you, things that help you keep going day to day and not lose track of, you know, the big picture. So I really highly recommend something like that. So some other things, automating. I said this in the savings piece, is if you can automate, you know, what's going on, whether it's paying your debts or automating, you know, the deposit of your income into your bank account, really a good way to kind of make things happen and stick to it. Because the less that you have to touch and the less willpower you have to access, the better off you'll be. Because one of the things you probably have seen, Mark Zuckerberg, who is kind of famous for wearing like just a plain hoodie. His whole wardrobe is full of just plain hoodies, because he says he has to make so many decisions and do so many different things. He needs to reduce the amount of decisions he has to make. And so deciding what to wear is one of those decisions he just eliminated from his life. And so if you can eliminate the need to utilize your willpower, right, to put money into savings or to not spend on frivolous things or whatever it is, but if you can reduce the amount of willpower that you have to access, then that means you can utilize that willpower for something else. And so automating your savings, automating your spending on the things that are most important, that's going to help reduce the amount of willpower you have to use, and you can then utilize that willpower for some other thing. There's a book called Atomic Habits, and it's very helpful. And they ask, and James Clear is the author, and he asks, can you just improve 1%? Can you just improve by 1% each day? And just keep doing that. And so just like the breaking goals into smaller pieces, walking around the block and then later taking a jog and then later, you know, jogging for a longer distance, can you just do that a little bit better each day? And so maybe your walk around the block ends up being, you just pick up the pace a little bit the second time, and then maybe you go, you know, 2 blocks, or you go just a little bit longer, or you take the scenic route a little bit, you know, on your walk. And then, you know, it's just slow incremental improvements, right? If your goal starts with something like, hey, I just need to exercise for 2 minutes each day, it's really hard to tell yourself, oh, I just don't have time for that, because it's just 2 minutes, right? Like literally 2 minutes. And then later, as you kind of make that a habit and you're doing that constantly, you can say, okay, you know what, let's add another minute to that. Let's add a little bit more. And the biggest thing that I could say is put pen to paper, meaning actually write down, take a pen and write down, this is what my goal is, this is what I'm going to do. And so you can see it, because people who share their goals are much more likely to stick to them. If you tell someone about it, if you write it down, if you put it out in the world that this is what I'm going to do, you're much more likely to stick to those goals. So those are my recommendations there. So that kind of wraps up what we got for New Year's resolutions. Future workshops that are going to be coming up for the Butte County REACH program would be on tax planning. We're coming up on, right now it's the end of January, but we're coming up on March and April pretty soon here. March is when business taxes end up being due, and April is when personal taxes end up being due. So we're going to have some videos on that. retirement planning. How much do I need for retirement? How do I save appropriately for retirement? What are some ideas to help save more effectively? We're gonna have a video on there. How to pay down debt the most effectively, looking at interest rates, looking at which debts you should worry about paying down and which ones you don't necessarily need to be so concerned about. We'll have one on that. Credit scores and credit cards, how to build your credit score effectively, how to tackle maybe inconsistencies or things that may be wrong about your credit report, how to handle identity theft. That's a big one in terms of credit scores. So we'll talk about that. And then things kind of a little more fun is talking to your kids about money, right? How to get your kids into good money habits. So those are some that are coming up. So keep an eye out for those. You can always go to Butte County's website, check out the REACH program. There's links there to see previous videos. And then when we have live videos as well, Friday mornings, you will be able to see those and log in and watch and listen to them live as well. So I will leave you with a quote: "A goal without a plan is just a wish." And so please take away from this that if you have a goal, come up with a plan, make a plan to reach that goal. And I appreciate you all watching. Thank you and have a great day.